Real estate investing is made easier with REITs, or real estate investment trusts. In this video, we're going to talk through real estate investment and how it works with your net worth. John and I have different opinions about how we work it into client portfolios. By the end of the video, you'll understand how to rethink or think through investing in your REITs, and how it works with your portfolio. Hi, I'm Bridget Sullivan-Mermel, and I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shear. I have a fee-only financial planning practice in Middleton, Wisconsin. And before we dig into REITs, I want to remind all of our viewers to hit that subscribe button. That helps other people find our content on YouTube. So hit subscribe, and then let's talk about REITs.
Yeah.
This is great. I think one of the things, as we were talking before we hit record, is that REITs are an individual thing, like buying stocks, right? You can buy a company, but you buy this REIT. And what we both, I think, talk about with regard to REITs is buying mutual funds, right? Where a fund company doesn't buy one REIT, they buy 100 or 1,000 or some diversification. So when we say REIT in this context, we're talking about REITs as a mutual fund option, right?
Yeah, because the way that some investment properties are financed is they put together an LLC typically, and a bunch of people invest in it. And typically the insiders get the first crack. So the developers and the people who work for the developers and maybe the contractors all can invest in it if they want to. And then they go to the bank for financing. Okay. And so then if they need more money on top of that, that's when they go out to outside investors. And that's when these REITs are available. And again, we'll get conglomerated into a mutual fund.
Right.
Okay.
So tell me, I mean, again, you mentioned in the introduction, we look at things a little bit differently. I think REITs as an asset class really fit in somebody's portfolio sort of in general, and you take a little different approach to applying
I think that having exposure to real estate in your net worth makes sense. Okay. So how do you get that exposure? One way to get that exposure is to own a principal residence. So you own a property, you have kind of your own little REIT, sort of, in a way. You know, you've got your own your own real estate exposure by owning a house. Mm-hmm. And it protects you against inflation, and you have a lot of control over it, all right? You negotiate with the bank, you pay everything, you improve the property or not improve the property, you decide when to buy and when to sell, etc.
Yep.
So you have a lot of control over that. And then some people have rental property or vacation homes or own other property, etc. So that's a secondary real estate in your portfolio. Okay, in your total net worth. And over your lifetime, I like to see people have like maybe a third of their total net worth in real estate. Okay, maybe, and that's like over your lifetime. So sometimes it's zero, and then sometimes it's more. It just depends on what your situation is. Okay, so I look at it as a way to have it in your entire net worth. And I say, okay, if you don't have enough exposure there, and we really want more real estate exposure, that's when we talk about buying a REIT and we put it in your portfolio. Okay, so I use those in very specific situations, and I don't have it as a general asset class in the client portfolios.
One of the things I like about how we both work together, and I think this comes from our membership in the Alliance of Comprehensive Planners, is that real estate is an important part of most people's big picture of their net worth, right, of their financial success. It's not, well, how are your investments doing, or how much cash do you have in the bank? It's, cash reserves, and it's real estate, and it's investments, and, so it's this holistic viewpoint. And so I really appreciate how you look at having a personal residence or a rental property or having a real estate mutual fund as being similar things. I take a little different approach in that so the real estate investment trust mutual funds that we both use in with clients invest in slightly different things, and so I take the approach that having personally owned real estate like your vacation home and your primary residence fits one component, but from a purely investment standpoint, having REIT mutual funds that invest in things like shopping centers and office buildings and agricultural, farms, those sorts of things, that provides a different set of exposure to real estate. And so just a little different view on that I think, shopping centers these days have a lot different risk profile than personal homes, and same thing with apartment complexes and office buildings. And the reason that I use those in the portfolio is that there's some evidence that says, listen, real estate as a corporate entity, meaning those areas that I was just talking about, has different risk and return characteristics than large company stocks in the U.S. and small company stocks have a different profile, and international stocks. And real estate gives it some diversifying factor from this one place of looking at it. So I take a little bit of a different view on the same topic with things. And one of the things that I think is really important to point out is that with real estate and sort of in general, there's limited upside, right? There's only so much value you can add through the real estate side of things to a property. And at the same time, there's limited downside as well, right? Real estate doesn't always work out well as an investment, but it rarely goes to zero, right? That office building, that personal residence, that vacation home, it can go down significantly, and people sometimes forget about that, but it rarely goes to zero, right? There's going to be some value. So there's some sort of floor, also maybe some limited upside. So that's where, again, from an investment standpoint, strictly, I look at it in the portfolio.
Okay. I was never in high school debates, but now I feel like I'm getting my debate chops satisfied with this. Okay, so here's some more things to think about with real estate. Okay, let's talk about if you've got a large mutual fund, an index fund that has everything in it, right? And let's talk about, I'll just use a couple examples. Let's use McDonald's and let's use Disney, okay? I've heard McDonald's described as a real estate company with a hamburger stand attached.
Yeah, right.
Okay? And I can't imagine that Disney doesn't have a lot of real estate, Okay, and actually I have personal experience knowing more about Starbucks and how they are operated. And actually, I don't think they own much of... It's not like every store is a company. They're all company stores, but they rent.
Yeah,
at least when I was working there, they did.
Yeah.
So, and I don't think that's any big surprise to anybody. But anyway, so there's you've got a lot of real estate exposure anyway, baked in to McDonald's, baked into Disney, baked into a lot of the large companies. So to me, that's on the side of why have a REIT. You've already got real estate exposure.
Yeah, that's a great point, that some of those companies, take the McDonald's and the Disneys that have, vast tracts of land, do some other investing. That does make it hard, I think, in general. You think about how consolidated various businesses are. Right. You investing, if you want to invest in tech companies, well, they own real estate. And if you want to invest in, a given company, they've got 4 different lines. They've got financials, they've got development and things. And so it does muddy the waters a little bit for sure. And that's a great point. It's not like you don't have any of these things. And so this is to focus on those areas. The description that you made, Bridget, I think, we get questions occasionally on, I think the future is going to be in healthcare, so I want to focus on healthcare. A couple of years ago when the pandemic hit, Zoom and virtual things. I want to invest in virtual, technologies because that's going to change the world. And, I didn't argue with clients a couple of years ago, and I'm going to take away perhaps your debate. And you go, listen, those things make sense. But, and as I would explain to clients a couple of years ago, listen, you've already got Zoom in your portfolio. You've already got these things, but it's this little sliver of things, right? And so it's part of this big part. And my argument, such as it is that with McDonald's or some of the other companies, you do have some real estate, but it's a sliver compared to a focus. And like the clients that say, geez, I want to invest in Zoom sort of thing, you're focusing your, more risk and return on that one area. And that is something that intentionally I choose to do, is focus the risk and return on that real estate slice of things. So I guess I kind of agree with you on it, but then intentionally choose to take more of a concentrated position in that. And, it's interesting. I want to make sure we talk a little bit about how much you should have in your portfolio and how to do it. And this reminds me that this isn't like building an airplane where there's one way to make sure that there's the right aerodynamics so that it flies. There's different ways to approach this. It's not unreasonable to say, listen, I've got personal real estate. My companies have some real estate. I don't need to have extra exposure to real estate.
Right.
there's evidence that says, listen, having extra exposure to real estate gives you some diversifying factors, right? It's not like there's one way to accomplish these things. It has to be thoughtful. You have to think through those things. For our viewers, how much real estate should you have? I love and I believe in what Bridget says, something like a third in real estate at various points. When you're younger, it's usually a higher percentage of your net worth. As people get older, typically a lower percentage, but it fluctuates over time. From a pure investment standpoint, how I look at it is saying, of your stock allocation, something like 10% in REITs, and of course you have some bonds in your portfolio, so it's not 10% of the whole portfolio, but 10% of the stock allocation going to REITs gives you some of that diversification within the investment only portfolio. So that's how I look at that for clients. Do you have any other takes on how to look at how much real estate should somebody have?
I agree with what you're saying, but there's another point that I want to bring up, and that is if you're picking a REIT, what I would look at, and I'm interested in what your take on this is as well. So if you're picking a mutual fund that's a REIT, and I'm just being conservative here, but I would want one that it's been around for quite a while, because I would want one that has been around since before 2008, so I could see their track record, even with a huge downturn. Because REITs are all going to be looking good after 2012.
Right.
Because every real estate's done nothing but going up for the last 10 years.
Right.
But I'd want to see one with at least a 15-year, probably 20-year track record, only because of the recent downturn.
Right, and that's maybe a little different perspective than some other things, some other types of investments, some other types of mutual funds, and I agree with that. This longer-term time horizon, especially with what's going on recently, in that real estate continues to go up, seemingly every year, but you go back 15 years, and there were some pretty ugly times. And how do they navigate that? I think it's a great tool for viewers as they're thinking, hey, this REIT thing sounds kind of good, and maybe I want to do some of that. Take a little bit of a longer-term view on as far as evaluating what the fund managers have done.
Right. So I think that's a great place to wrap up. I am Bridget Sullivan-Ramel. I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shear. I have a fee-only financial planning practice in Middleton, Wisconsin. And if you like what you hear on Friends Talk Financial Planning, both Bridget and I are members of the Alliance of Comprehensive Planners, a nationwide group of fee-only tax-focused financial advisors. And visit acplanners.org to find an ACP planner in your area.
And don't forget to please subscribe to Friends Talk Financial Planning. It helps us be found with the YouTube algorithm and really helps us out.
Great.
With that, thanks.